What's up, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to do some stock analysis for Skyworks Solutions. And this is stock ticker SWKS. This company makes semiconductor chips, and they mostly operate in the segment of electric vehicles, in Wi-Fi devices, in Bluetooth devices, in mobile gaming, in different AR, VR products, internet products, all that different stuff. Now, one thing you should know about this company is that Apple is their biggest customer, and they account for about 50, I've seen anywhere from 58 to 68% of Skyworks revenue. So you can look at that as a good thing and a bad thing. The good thing is that they have Apple as their customer, which is probably the best customer you can have. But it's also bad to have, 60% of your income or revenue coming from one person or one company. But the other way you can look at it is if they were to lose Apple as their customer, which is possible, but there are no, clear signs of that happening anytime soon. If that was to happen, you would think they'd be able to get other customers pretty easily, being that they just came from working with Apple for however many years. So if we take a look at the stock here, we're looking at a $105 share price with a market cap of about 16.8 billion. As you can see, the last 5 years, it's up 12%. It's pretty much hung around this $110 mark for a lot of the time. But in 2021, when we had our big bull market, it went up to close to $200. And the semiconductor industry is kind of known for being volatile. So I think just a lot of different companies operate like that, whether it's Qualcomm or whether it's Intel, whatever it is. A lot of semiconductor companies, their stock just moves all over the place like that. So if we get started with the checklist here, we're going to look at the revenue. We're going to see that it averages about 13% growth per year over the last 10 years. Last year, they did $5.49 billion of revenue. And so that's pretty good for a company that's worth $16 billion. And 13% growth is also pretty healthy. So although you can see there is volatility here, there is, a clear pattern of growth, though. They have been pretty consistent since 2009 of growing, from $800 million of revenue to over $5 billion. So I will give that one a check mark. Then if we look at net income, we're going to see they've been growing that about 20% per year over the last 10 years. So that's also pretty strong. We're looking at $1.2 billion of net income for the trailing 12 months. And, that's also a strong number. So we're going to give that a check. Going to the PE ratio, we're going to see it's about 13. It's trading at about 13 times. And on average, it trades at about 16 times. So here's the chart over the last decade. It's pretty much in the middle. No, I guess this is saying that it's trading at a 16, but if you run the numbers, it looks like it could be a 13 as well. So I would say this is a pretty fair valuation. It's pretty much right in the middle. It goes as low as a 10 and as high as a 28, but I would say this is a pretty healthy valuation. So that'll get a check. Then we move on to, are they innovative? I would say yes. With all the different things they're doing with connectivity, 5G, we can look at, if you look at their investor presentation, it'll show you some of the products they work with and some of the different markets they work with. So they're pretty diversified, which is a good thing. I like to see that. They're benefiting from the whole 5G movement, the whole IoT, Internet of Things. And here you can see it's mostly IoT, but also automotive, infrastructure, audio, gaming, all that. So I would give that a check as well. I would say they're doing a pretty good job with innovation. Then we get to market share. I couldn't find an exact number for how much market share they had, but if you kind of estimate the numbers, it looks like the entire industry of semiconductors is worth about around $500 billion, about 550 billion or so. And they're doing about $5.5 billion of revenue. So that's about 1% that they have. So it's all, even though they have Apple as their largest customer, they still only have 1% of the market, but that's because this market is so big, $500 billion, and there's so many players. There's dozens of players in this space. And then the other thing you can look at too is, are they growing as fast as the industry? The industry is expected to grow about 7%. I've seen estimates as high as 12%, but it looks like 7% is probably more accurate. And either way, though, if the market's growing at 7 to 12%, and Skyworks is, although they had a good year in the last couple of years, the EPS has come down from 11 to 8, and then it's supposed to increase up to a 9. And we're looking at revenue of negative 13% this year and 5% next year. So still underperforming the entire industry 2 years at least in a row. So that's not really a good thing. So that I'm going to give that a no, unfortunately, but it is what it is. It's a pretty big market. Return on invested capital, very impressed with this number. We're looking at 20%. They're also pretty consistent with these numbers as well, which is something just as important to look out for. And you can see that last year they did about 19.9. In the past, they've gone as high as 31%. But overall, it's always about 15% or above 20%. So that's very strong. I'm happy with that. The equity is up 41% in the last 3 to 4 years. That's also healthy. That's good with me. That's fine. Equity is definitely over 15%. I think it's about $5 billion, and it's a $16 billion company. Share count decrease is consistent. We're looking at about 1.6% decrease per year in the share count. And that's something they talk about in the investor presentation, how they're buying back a bunch of shares. So that's good. Then we get to their assets minus good. So their assets are not 2x the liabilities if you take out goodwill. But if you keep goodwill in, then yes, it is actually 2x the liabilities, which for a company like this, I would think that, they have patents or whatever they have on their balance sheet, that I would expect it to be a large portion in goodwill. So that kind of makes sense. Although it's not 2x without goodwill, it's still healthy and strong. Profit margins over 10%. It's about 23%, similar to return on invested capital numbers. The profit margins are consistent and they're strong, always above 20%, all the way up to 30%. So I'm happy with that number as well. Cash and receivables is about 1.6 billion, I believe, and that's with them doing what, $1.2 billion of net income. Yeah, $1.3 billion of net income. So that's definitely healthy there. They got plenty of cash. Healthy dividend. Yes, I'm very happy with this as well. We're looking at a 35% payout ratio only. That's very small. And then they're also very consistent with the dividend, and they're pretty good with raising and increasing the dividend, which is something we're going to see in the news here. You can see that they increased their dividend to 68 cents as of 4 days ago. So that's something I like to see. And I could pull up that chart to show you how, really almost every single year, this dividend has increased, right? Well, 2015, it was 13 cents. Now we're all the way up to 68 cents. That's a big increase. So that number looks good. The company was founded in the 60s, so it's definitely over 10 years old. Growing free cash flow is consistent, up about 17% per year on average, which we will see right here. The last couple of years, of course, there are some ups and downs, but generally, they've come a long way from where they were in 2009 and 2012. They've come a long way to now doing over $1 billion on a pretty consistent basis. So that's also will get a check. So overall, we're looking at what? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Is that 13? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Yeah, about 13. So this is a pretty high score. That's why I'm pretty interested in this stock. I might start buying right at this price, but honestly, I would say the closer to $80 a share you can get it, the better. If some bad news was to kick in, because they did say that they're expecting a little bit of I think their revenue decreased year over year, and they're kind of saying because of inflation, people aren't buying some of these electronics and stuff. They're not buying as many iPads or iPhones, stuff like that. That's why they're kind of using that as a reason for the decrease in their revenue. So if there was, if this bad news, if a bad narrative kind of takes hold of this stock and an analyst says it's going to go down to $90 or $80, then this stock will keep falling, right? And the next couple of months will probably be weak for this stock. So the closer to 80, but I would say the closer to $80 you can get it, the better. That I would at least feel safer. I could buy in right now, and it's probably going to hover around this $100 mark for a while. But if it got really bad and it went to like 85 or 75 or something, then I'd feel more comfortable making a bigger position. So that's the way I'm looking at it. Looking at the 5-year chart, we're talking, it's pretty much at the same price it was at, in 2018. It's only up 12%. So, it kind of has its ups and downs, and you just got to get in when it's low. And then when the year comes where there's a big boom cycle, then you benefit and the stock will probably double. So that's the way I look at it. And yeah, I would say as it approaches, if it goes down to $90 or $80, I feel more comfortable making a larger position. And yeah, that is Skyworks Solutions. So thank you for watching. I will see you guys in the next video.